Hi, today there was a very interesting fact of financial news that came out. On May 6th, there was a very abrupt crash in the New York Stock Exchange. The Dow Jones Industrials average dropped by about 5 or 6% in just a few minutes around 2:40 p.m. And there's already a lot on there. There's some good video out there, that you can do a search on YouTube for May 6th, 2010 crash, I think, and find the full CNBC footage of the crash. And that people investigating it discovered that there was a trade where a bunch of contracts called e-minis were dumped at once. And e-minis are a financial instrument that should follow the value of the S&P 500 stock index, which is it's like the Dow Jones average, except the Dow Jones average only has 30 stocks in it because it was designed in 1897 to be computed by hand, and the S&P 500 has 500 stocks in it. And then an E-mini is something that is an investment in all 500 of those stocks in the same proportions as in the index, so that when you sell one, its price should depend on the S&P 500 index. And they're kind of big things, like normal stock traders don't have enough money to put in them. By normal stock traders, I mean individuals, of course. One of them is worth about $50 per point of the S&P 500, so one E-mini is about $60,000. And that they found that that there was a large single stock trade where 75,000 of them were sold, which was about 4 billion, and that was traced to today to a firm called Waddell Reed that I had never heard of. And of course, I'm not an expert on the stock market, but I looked into who they are, and their total assets under management at Waddell Reed were about 70 billion at the end of 2009, which it sounds like a lot, but for instance, Goldman Sachs is about 12 times that size. Um, so that the trigger for the crash seems to be a surprisingly small event, considering that the total value of the New York Stock Exchange is about $20 trillion, and that this sell-off was triggered by a sell-off of only 4 billion. Um, then also that it probably would require a larger sell-off to cause a crash on a normal day, because on that day there was a lot going on. That at the time the order was placed, CNBC was actually showing footage of rioting in Greece, and that if you look at the footage, you can actually see that there's a market drop right at a point where a line of riot police starts moving toward the crowd. And also there was the general election in Britain was that day, and there were considerations in the European Central Bank about what to do about the debt crisis. So people probably saw the drop, thought that someone had some inside news, and set off their own trades, and that the sell-off actually reached the point where there weren't any buyers for the stuff, and so it set off a situation where the price isn't really very well defined, and that you can see that the market went back to its original value in just a few minutes after the crash. Um, but the important lesson here is that that this strange event was triggered by something that is surprisingly small. I mean, when you consider that Goldman Sachs, as I said, has 850 billion under management, and this was only a $4 billion trade. There's a lot of people that potentially could do strange things to the market if they really wanted to, and so this really needs to be looked at by both the financial regulators and even the exchanges, I think, really don't want this to happen again, because if it happens very much, people think that your market is a casino.